It's time for Yahoo Finance's Market Minute. Stocks rising to start the week as investors navigate changing trade policies. Apple shares jumping as President Trump grants tech some reprieve from tariffs. Smartphones, computers, and other consumer electronics are exempt from those reciprocal tariffs, but will still face sector-specific levies in the near future. Meantime, NVIDIA announcing it's working with its partners to produce AI supercomputers entirely in the U.S. for the first time. The chipmaker plans to make up to $500 billion of AI infrastructure investments into the United States through partnerships with the likes of TSMC and Foxconn. NVIDIA is already producing Blackwell chips at a plant in Phoenix, Arizona. And Goldman Sachs topping analyst expectations in its latest quarter, its profit jumping 15% year over year, boosted by its trading business as investors take advantage of volatile markets to make big bets. That's your Yahoo Finance Market Minute. For more on what's trending, scan the QR code to track the best and worst performing stocks.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup. One manager talks about the benefits of being a stock picker in this market versus an indexer. We're going to explain that. And crypto is one of the many assets we've seen pull back in the last month. Is now the time to buy? We get one perspective. Plus, home equity, once a financial safety net for many, is becoming a harder to tap asset. An economist explains that. And finally, all week on Wealth, we'll dive into the class of 2025's financial playbook. Whether you're a new grad or a parent of one, we'll break down the basics that you need to build a strong financial foundation. You do not want to miss that all week long. But first, here and now, as Luther Vandross would say. Let's check in on the major averages. Looking at the market action 90 minutes into trade, we've got gains across the board right now. Stocks in the green to start the week as temporary tariff exemptions boost tech stocks. Joining me now, we've got Brian Frank, who's the Frank Value Fund portfolio manager. You say stock pickers, they can invest and it be a little easier here and avoid the difficult. So explain what you mean by that.
Yeah, sure thing. Hi, Brad. Good morning, and thanks for having me. We love being stock pickers, especially in an environment like this, because indexers basically have to buy everything. So when things are going wrong or risks are showing up like tariffs, if you're an indexer right now, you have a huge exposure in the S&P 500 to big tech companies, which might be on China's radar. You have exposure to healthcare companies where tariffs are forthcoming. We haven't even gotten that information yet. And lots of other problem areas and cyclicals because we might be entering a recession. So as a stock picker, I can kind of go around all of that noise. And in the Frank Value Fund, my mid-cap value fund, we're just focusing on the areas that are kind of easy, things like electricity production, just things that are always going to kind of go up and to the right and aren't so cyclical, aren't so exposed to tariffs. And, when everything's great, maybe indexing can make kind of sense. But when there's a lot of risk on the table here, it's great to be a stock picker instead of an indexer.
Okay, so what are the picks?
So what are the picks? We love independent power production. So that's a kind of a subset of the utility segment. So the difference between independent power producers and regulated utilities is independent power producers are in areas of the country like Texas, where it's a non-regulated electricity market. So our number one position is NRG Energy. We've owned this since 2003. We've raised it. We've sold when it was much higher. And in the pullback here, we've once again made it our largest position. So NRG is an independent power producer, and they're benefiting actually from the electrification of the grid. And what that means is all these AI data centers, anybody plugging in an electric car at night, and any factory opening up in the United States is more electricity usage. And electricity was kind of a sleepy market the last 20 years, but now we've kind of come and used all the efficiency up. All the Energy Star efficiency has kind of run its course, and now electricity usage is really starting to go up. And these companies are right in the driver's seat of benefiting from this trend.
So it sounds like if you're going to be stock picking, then you still need to be somewhat defensive and look at the companies that this pick would suggest are, companies that are going to benefit in any environment. It's just a matter of what their output and what their overall kind of ramp towards future revenue drivers might look like.
Oh, absolutely, Brad. And it's great to be defensive when, yeah, things are kind of when risk is increasing around the globe here. But the really interesting thing about NRG is when we got into it, it was a defensive position with not a whole lot of growth. But now you have companies like Microsoft and Amazon clamoring for space to put their data centers. And it makes a lot of sense to put your data center right next to the production asset, the electricity producer. So if you have a natural gas plant or a nuclear power plant, you have a lot of land. And these companies, Amazon, the big tech companies, want to put data centers right next to them. So this has gone from a sleepy defensive company to more of a growthy type name. So it's kind of the best of both worlds. And that's the beautiful thing about stock picking is you can get growth at a value price if you're just patient and also very targeted. I run a concentrated fund, fully invested, we're 20 to 30 equities. So it's really strict criteria, and we can kind of get the best of both worlds if you're very patient, but also take advantage of opportunities like today.
And the key with that and the stock picker's mentality is looking to outperform the broader market. So what is the general rule of thumb as you're kind of going down your own checklist for companies that you may be stock picking, but also looking to outperform the broader market there, Brian?
Oh yeah, that's why we exist, is to outperform the indices. So the Frank Value Fund's benchmark is the Russell Mid Cap Value, and since we transitioned our strategy to be mid cap value in early 22, we've outperformed that index every single year. We've even outperformed the S&P 500. So our criteria is quite strict, and that change that we made in 2022 was to start looking at catalysts that release value. Because anybody can find a cheap stock. You can run a screener on Yahoo Finance and find, low price to book, low price to earnings, but a lot of those are value traps. So our research centers around how does that value actually come to us, the shareholders. Specifically with NRG, they have a little dividend. They have a large stock repurchase program. Stock repurchases are one way to release value and also to outperform the index. So we look for 20 to 30 companies that are being very shareholder friendly, whether it's through M&A, share repurchases, dividends, or some other way to get the value to us. And it's working. It's done great for us.
Brian, thanks so much for taking the time here with us. Appreciate it.
Thank you, Brad.
It's now time. It's now time for some of today's trending tickers. We're watching Bitcoin, DuPont, and Peloton. First up, Michael Saylor's Strategy, buying more Bitcoin amid the recent volatility. Strategy bought $285.8 million more of Bitcoin last week, its latest purchase of the cryptocurrency in a series of purchases starting in late October. Bloomberg says Strategy now has holdings of around $45 billion. The company is the largest corporate owner of Bitcoin. Next, chemical company DuPont catching an upgrade after the stock's recent sell-off. KeyBank raising its rating to overweight from sector weight. KeyBank says that the company's strong balance sheet could allow it to weather a possible economic downturn. The analyst calls DuPont's electronics and water divisions, quote, world-class secular growth franchises, and that possible tariff exemptions could de-risk downside for DuPont. The firm sees more than 37% upside for the stock as of the last close. And finally, Peloton getting an upgrade to buy from hold at Deutsche Bank. The analyst thinks the stock has been hit too hard since its last earnings report. Although the firm does expect Peloton to see rising tariff costs and growth pressures, they believe the earnings could do better than expected over the next year. The analyst's price target is now $6.60. That's about 18% upside from the last close. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. The New York Fed just dropped its latest survey of consumer expectations for March. Our very own Alexandra Canal is all over this, over at The Touch with the latest. Hey, Allie.
Hey, Brad. Yeah, a lot standing out to me in this survey, but what really caught my eye is those unemployment fears. And those worries have risen to their highest rate since the pandemic, with more Americans anticipating job losses to jump next year. According to the New York Fed, mean unemployment expectations, that's the mean probability that the U.S. unemployment rate will be higher 1 year from now, that jumped 4.6 percentage points to 44%. That's the highest level since April 2020. Similarly, the average expected likelihood of becoming unemployed in the next 12 months, that increased by 1.6 percentage points to 15.7%, the highest rate since March 2024. And then finally, the probability of leaving one's job voluntarily in the next 12 months, that ticked up only slightly, rising by 0.4 percentage points to 18%. And to note there, that's far below the 12-month trailing average of 19.7%. If we take a look on the inflation side, average year-ahead inflation expectations, they increased by 0.5 percentage points to 3.6%. They were unchanged at 3% at the 3-year ahead time horizon, and they actually decreased by 0.1 percentage point to 2.9% at the 5-year ahead horizon. And then finally, I want to talk about those stock price expectations because they declined and reached the lowest level since June 2022. And this is all coming as consumers are really trying to digest the tariff whiplash that we've seen from President Trump. Economists, they're constantly chasing and revising a lot of those forecasts to account for this. And we've seen some of this fear trickle through into a lot of that soft survey data, this New York Fed survey data being one of those. Now, we've seen pretty encouraging signs on the hard data front. We just saw a pretty solid CPI print. We saw pretty solid unemployment print for the month of March. But there's still a lot of concerns over what all of this could mean for the future. And a lot of economists have really looked through a lot of this recent data. So all things to watch and all things that are just really weighing on everyday Americans as they try and parse through all of the headlines that we've been getting. And right now, it seems like there's no signs of stopping that anytime soon. Brad.
Thanks for breaking this down, Allie. Really appreciate it. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Tech companies getting a temporary tariff reprieve after the Trump administration announced smartphones, computers, and other consumer electronics will be exempt from reciprocal tariffs. But the tech products will still face sector-specific levies in the near future. Yahoo Finance's Josh Lipton is here now with a closer look at this. So give us that closer look.
That's right, Brad. So investors in technology companies we know have been navigating the Trump tariffs, trying to make sense of the headlines and figure out how and when and whether to commit capital to this sector. It has not been easy, and the news just kept right on coming over the weekend. It was announced on Friday evening that the Trump administration had made what looked like a big pivot, announcing exclusions for smartphones, computers, and other electronics from the president's so-called reciprocal tariffs. Now, analysts were quick to say that this was, in their words, a major relief for companies like Apple, as the tariffs could have driven material cost inflation for the iPhone maker. But then the president appeared to push back on Sunday afternoon, posting on social media that there was no tariff exception announced on Friday, that these products are simply moving to a different tariff bucket, and telling reporters that a separate rate for semiconductor tariffs will be announced over the next week. But Apple moving higher this morning, as our Yahoo Finance colleague Ben Werschel reports. These tech companies' goods, they're still subject to 20% blanket tariffs on China over fentanyl, and likely do face sector-specific tariffs from Trump 1.0 and the Biden era, but they are able to now sidestep the lion's share of that 145% rate now in place for other goods. CFRA's Angelo Zeno telling his clients this morning, Apple is clearly the biggest winner across the technology space, avoiding a worst-case scenario. He views the temporary exemption as going a long way toward providing better visibility, he says, and no longer expects drastic revenue and EPS revisions to his forward estimates. Brad, back to you.
All right, this is an amazing move that we're seeing on Apple on the day with the jump in those shares in response to this. Josh, thanks so much.
You got it.
Switching gears, Bitcoin is up around 23% since the election of President Trump back in November, but it's trading below the all-time highs that we saw in January, where the cryptocurrency popped above $109,000. With the recent market pullback, Bitcoin hasn't traded above $90,000 in more than a month. So, is this a good time to buy the cryptocurrency? Here with more, we've got Tyrone Ross, 401 financial principal and founder here. Tyrone, you own Bitcoin. You're saying that you're always buying. So is now the right time for people to add to their positions, even as we're off of that $109,000 peak that we had seen at the beginning of this year, but haven't been able to get back to that level?
First of all, good to see you, my man. And let's start here. I think whether it's Bitcoin or not, when any asset that you feel is worthy of your portfolio is off the highs and you have conviction and you thought it through, you should be buying. And I think there should be a long-term plan to that as well. But I do think, Bitcoin pulling back here and cooling off a bit and just kind of floating in this range, this $80,000 to $85,000 range. For the people that do look at it long term, for who see the investment thesis in it, I think this is a very prudent time to be adding to allocations based on, your time horizon and your financial plan.
So let's separate investors into buckets. What about people who don't currently own any Bitcoin? Is now a good time to buy in?
No, it's not, because I think there's a lot that goes into making a first-time investment in this. So that's the first thing. If you are a long-term investor and you can tell me why you would buy Bitcoin now as a part of achieving your financial goals, I'm all for it. If you are a trader and you're just doing this because you're seeing it online or some TikTok video, then it's a resounding no. So I think the most important thing for people to do is learn, ask questions, see if it makes sense for you. Is it tied to a viable and prudent financial goal? Sure. Dollar cost average. So the peaks and the highs doesn't matter. You're constantly adding money with a strategy, and then you'll be in it for the long term. But worrying about the price of Bitcoin in 2025 is foolhardy to me.
What about other altcoins? Because naturally people will think about, well, wait a minute, wasn't the flippening supposed to happen? And us looking at Ethereum overtaking Bitcoin as the most valuable cryptocurrency. How are you evaluating the rest of the crypto landscape?
I would encourage those people to pull up any portfolio tracker, coin market cap, whatever that is, and look at the performance of altcoins. Just look at 6 months, look at the year, and just look at all of that red and see if that's somewhere that you want to be. I think the main thing is this: is there money to be made in obscure coins besides Bitcoin? Sure. But if you want to go into altcoins, you are going into an alternative universe as well, of which you probably have no knowledge. So I think people should look at altcoins once they understand Bitcoin, once they've seen how it performs, how volatile it is, and then see if you want to take, 10 times, 20 times the risk in an altcoin. It's obscure that you probably don't understand anyway.
So what from the administration do we still need to hear more on to really get a catalyst, the next catalyst for cryptocurrency and for Bitcoin specifically, especially as the campaign and those trails we're talking about Bitcoin strategic reserve and making sure that there was government buying, or at least that it sounded like there would be government buying of Bitcoin, but there are some fiscal hawks out there that would say, well, wait a minute, not so fast.
Yeah. As the resident crypto hippie for the wealth management space, I will say this: it would be nice to get some clarity on, again, what securities, what is not, what is going to happen around custody. But this administration has clearly demonstrated they're pro-crypto. It has been great for all things crypto assets, builders, entrepreneurs, investors, the whole case. Again, I think some clear stable coin legislation will be great. I think we have a new SEC chair that's nice. Hester Peirce and a lot of the folks at the SEC has been trying to clean out the gut of things that have been in there. The strategic Bitcoin reserve, right, and the crypto stockpile are interesting. That's a conversation for another day. I'll come visit you personally. We'll talk about that. But I think all signs point to getting clarity here. President Trump last week, by executive order, removing some of the stringent laws and attacks on DeFi protocols and things like that. So you're seeing some progress here. And I think the catalyst to get us to the next level is when we finally get clarity on what is the SEC in control of, what is the CFTC control of, and then ultimately you'll start to see more projects launch.
Is the bigger catalyst government buying of Bitcoin or private company buying of Bitcoin, or private sector, I should say, buying of Bitcoin? We were just talking about MicroStrategy, or Strategy now, the artist formerly known as MicroStrategy, and the amount of Bitcoin that they hold and continue to increase.
Yeah, the biggest catalyst is retail investors buying, and they aren't. Retail has been burnt, and they're away. I'm not a fan of the government buying Bitcoin or buying crypto. That's just me. I think corporations, yes, you're starting to see some more conversations around corporations adding it to their balance sheet. But the missing catalyst here is my Aunt May, who makes the really good sweet potato pie, also calling me and asking me about Bitcoin. She's not doing that. So if that's not happening in retail land, it'll be hard for us to get to new highs and push through that.
All right, when you hear from Aunt May, send me a plate, Tyrone. Appreciate it.
I got you, my man.
Thank you. Appreciate it. Coming up, the biggest risk facing retirement savers in the current market. We've got tips to help you avoid it next on Wealth. We're 2 hours into the trading day. Let's get a check in on the major averages and some of the market activity that we're seeing transpire here during the session. The Dow Jones Industrial Average holding on to gains of about 0.8%. We're seeing the NASDAQ Composite Tech-Heavy Average. That right now is up by about 1%. That is a very long-term chart. Let's put this a little bit more intraday so you can see what's transpiring in real time. And we've largely been in gains, actually, throughout the day. We've been in positive territory here. We're at some of the session lows, as you can see, for the major averages, but still handedly in the green as of this juncture. Let's take a look at some of the sector activity. 11 sectors in the S&P 500. We've got them loaded up here for you on the screen, and we're still positive across the board right now. We're seeing XLRE trade places with XLK as the leader here. XLK led out of the gate this morning here. You're still seeing, though, solid gains for the technology sector, utilities, staples, and real estate. You're seeing those really move to the upside and really lead the rest of those sectors here. Speaking of technology, taking a look at the NASDAQ 100, as of right now, you're seeing Apple still hold on to some really solid gains. As of this juncture, up by about 2.75%. Google, Alphabet, whatever you're calling them at home, call them higher by about 1.9%. However, we're seeing a reversal here for Amazon. Amazon is now down by about 1% after starting the day out in positive territory, trying to reclaim that at the start of the 11 a.m. hour, but now you're seeing that during this hour move back into negative territory. We're going to keep close tabs on that one, as we will Meta here. Of course, that is going to be the central point for Capitol Hill as those hearings play out this week as to whether or not Meta and the acquired social media platforms that they've been able to grow up to some mega status here, whether that's actually gets some of the monopolistic type of tags, name tags thrown on it here. It has by some of the representatives, and we'll see exactly what those conversations look like. As of now, you're seeing Meta move lower by about 1% after starting off the day in positive territory. Well, taxes are due tomorrow, April 15th. And if you're disappointed with your return or just looking for some strategies for next year, Ashley Weeks, TD Bank Wealth Strategist, is here with some tips. Ashley, great to have you here in studio with us. So what are some tax-efficient strategies that can help savers build long-term wealth?
Absolute pleasure to be here, Brad, and thank you for the question. Our favorite adage is the only free lunch in investing is diversification. You might have heard that before. Actually applies the exact same with tax planning. So when we're advising clients, very often it makes sense, to the extent someone can, to allocate their portfolio amongst various types of accounts. It's a good idea to have some taxable accounts, some tax deferred, like your traditional IRA, your traditional 401k, and some tax-free money in a Roth account. And the reason that is so appealing is we don't know what tax rates are going to be in 20 years, and candidly, right now, we don't know what tax rates are going to be in January of 2026. We'll see what Congress does. By having assets allocated amongst different types of accounts, you give yourself flexibility. You can react to whatever Congress does long term.
And so with that in mind, as you're thinking about where some of the tax strategies have played out this year, what are you hearing from clients? What is the firm kind of recommending, even as we've got these final moments left in the filing season?
Yeah, so, filing season 2024, it's done. We're now looking at 2025. A very popular topic that's gotten a lot of coverage in the financial press is looking at Roth conversions. There's a massive amount of money that's floating around out there in pre-tax retirement accounts. Clients understand that not only do they have to pull that money out at age 73 or 75 if you're born in 1960 or later, those withdrawals are subject to ordinary income taxes. Our federal debt, it's approaching $37 trillion right now. So the idea that taxes are likely to go up in the future, that's not totally out of bounds. Very often we consult around, does it make sense to do a Roth conversion, pay taxes now, move money into a Roth account? And there are a number of strategies to do that. I tell clients the cheapest time is when the market bottoms. So if they tell me when the market bottom is, that's the best time to do it. But there are a number of ways to get that money over.
Certainly. And so shifting gears to retirement here, as we're thinking about what all of us want to get towards, a new survey from Northwestern Mutual, it actually found that the Americans believe, all of us out there, we believe we need an average of $1.26 million saved to retire comfortably, according to this survey. And more than half think it's likely that they will outlive their savings. So what are the biggest risks facing retirement savers in this market right now?
Sure. Great survey. I would say that all depends on what you're likely to spend and what your other resources are. If you have a massive pension, most people will have Social Security. You might not need that figure. If you're planning to spend a lot and do a lot of travel and perhaps do a lot of philanthropy, you might need a lot more. As far as risks, though, the single greatest danger that near retirees and those who've recently retired face is having a big drop in their asset value in that 5 years right before retirement and the 5 years after, sequence of returns risk. And the reason that's so damaging is because time's not on your side. If you suffer a big loss as you go into retirement, you typically have to sell into that loss to liquidate funds to live off of, so you don't get the benefit of a rebound. That's risk number one. We plan around that. We advise being very defensive in that retirement red zone. And risk number two is people simply aren't saving enough for retirement.
So how should retirement savers then be approaching this market?
Yeah, so candidly, if you're a younger person and you are in your first job or even mid-career, if your time horizon with your investments is long-term, if you're not going to touch these funds that are going into your 401k or your IRA for at least 10 years, it makes the most sense to be full risk on. Now, there have been periods in the past where you could have invested into the S&P 500 on day one and not seen the value increase in nominal quantities until 7 years later. Indexed for inflation, it could be 14 years later if we look at the dot-com bubble. So it's all about time horizon. If time's on your side, let the market do its thing. If it's not, if you're coming close to retirement, you definitely want to be more defensive. Look at high quality investment grade bonds, treasuries, brokered CDs, things that will protect your principal.
How will policies from President Trump affect retirement saving to the best that we can really kind of analyze at this point?
Yeah, so it's tough to say. We're still waiting to kind of see what the fallout is from Secure 2.0. That's the recent big piece of retirement legislation it's phasing in this year. Starting this year, new 401ks have to automatically enroll participants. Starting this year, there's an extra catch-up contribution. If you're between ages 60 to 63, you can throw even more money into your account. Those are useful, but again, there's some limitations. You can always opt out of automatic enrollment, and even with higher contribution limits, that's still the workers' money that they're putting into their accounts. So it's on them to save. The real open question from my perspective is what's going to happen with Social Security long term.
Interesting. Ashley, thanks so much for taking the time here in studio with us.
Thank you, Brad.
All right, the countdown clock's on. A lot of people's kitchen timers are set for tax filing. Well, leaving a job, even if it's an exciting new opportunity that's presented, can deliver a blow to your future retirement stash if you're not careful. Here to explain, we've got Yahoo Finance senior columnist Carrie Hannon. Hey, Carrie.
Hey, Brad, great to be here. Yeah, this is a big issue for many people because, you might, have been laid off from a job or you're switching jobs, and it's so easy to forget about your retirement account sort of in the excitement or the dismay over it, whatever it might be. But we lose track of this whole pile of money we've set aside at a former employer, and it's really important to keep your eye on that and not lose track of it. And also, if you're between jobs, keep saving in any way you possibly can, in a tax deferred account of some sort, because that will really make a difference.
You say there are 4 things that you should pay attention to in terms of your retirement accounts if you're leaving your job or are laid off. And the first is paying attention to vesting schedules. What do people need to know about that?
Yeah, Brad, that's a good one, because vesting is something we do tend to forget about pretty easily. What that it refers to what your employer match is in the employer contribution to your retirement plan. Which, what can happen is the vesting period is technically, most companies are between 3 years and 5 years. Some automatically as soon as you start, but if you're most people change jobs, EBRI, Employee Benefit Research Institute, found recently in a study that people change jobs about every 5 years. That's bumping right up on that vesting. And if you leave a firm before you're vested, you leave that money on the table. And that is something you absolutely do not want to do. So with people changing jobs 8 or 9 times throughout a career, this is money that you really need to pay attention to. You might be able to sort of push back your start date if you're nearer to that vesting period ending, if possible, or if you've been offered a package, maybe there's a way to negotiate in order to not lose that money from your former employer.
Now, Carrie, the second thing that you say is don't forget about your retirement accounts. All right, I've been trying hard not to forget about my retirement accounts, but for those out there who have, how can they kind of reconcile?
Yeah. So basically, when you switch jobs, you switch to a new employer, you have a couple of options. And the first one is you can leave it right there with your former employer plan. And sometimes that's a great idea because if you're happy with those investments, you're getting great fees because you're paying institutional fees on those accounts. And you and I have talked about how fees can really erode your retirement savings over time. So that is one potential avenue. You don't want to forget that it's there, of course. But again, leaving in a former plan is not necessarily a bad idea. You can't add more to it, and you're restricted to those investments they have in that plan. The second thing you can do is roll it over to an individual retirement account. And so that is your own savings. You can make that decision where you want to divvy up that money into different buckets. You're going to pay higher fees there because it's retail. It's like wholesale versus retail. But that might give you the control and the opportunity to invest in things that you really want to. And you may also have an opportunity to move it to your new plan. Most people do the one or the first or the second options there.
And the third thing here, Carrie, pay attention to your new employer's plan features. What are some of those features that we can commonly look out for?
Yeah, gosh, I'm glad you brought that up, Brad, because here's the thing. Starting this year, most employer plans, 401k plans, need to automatically enroll you in the 401k plan and at a default rate of savings that they pull from your salary. So that can be anywhere from 3% to 10%, but they usually start at 3%. So here's the deal. Say you've been in your former plan, your former employer, you were saving, 10% of your salary. And now you're in 3%. And if you don't realize that they've automatically enrolled you at that deferral rate with a 1% automatic adjustment each year up to say that 10%, then you're going to be not saving at the rate you were in your former employer. And what you have to do there, and when they enroll you in that, you have the right to opt out or change that rate, that deferral rate. So this is your time to say, hey, what was I saving before? And make sure that you're saving that same amount in your new plan.
And the last thing here, Carrie, is to avoid early withdrawals if possible here. What do people need to know?
Yeah, this is a tough one if you're between jobs, if you've been laid off and you really need that money to live on. It's pretty hard not to want to tap into these retirement accounts. But if possible, try to refrain from doing that because you're going to pay tax on the amount you withdraw at ordinary income tax and a 10% fee for doing so if you're under 59 and a half. So I encourage people to, yes, don't feel bad. There's no shame if you have to do this. But if you do have to, do everything you can to, as soon as you do find new employment, to really buckle down on the savings because this is, you're saving for your life.
Carrie, thanks so much for breaking this all down for us.
Thanks, Brad.
Coming up, home equity becoming harder to access. Why millions of Americans are effectively blocked from tapping into their housing wealth. It's next. Home equity is the difference between your home's current market value and what you still owe on your mortgage. According to a new study by Point, millions of homeowners are unable to access their home equity through traditional loans because of shifts in the economy. Joining me now, we've got Aaron Terrazas, who is the Point economist. All right, let's back up for a second and just first talk about how Americans typically use home equity to their advantage. Can you break that down?
Of course. Well, great to be here with you, Brad. Americans typically use their home equity for 4 things. First and foremost is home renovation. There is an increasingly aging housing stock that needs to be updated. Second is higher education. Third is end-of-life care. And fourth is paying off higher interest debt. Those are the 4 things that typically Americans tap their home equity for.
And so your study found that two major shifts in the economy are causing millions of Americans to be locked out of accessing their home equity. Explain how the changing economy is contributing.
There are really these two forces converging at the same time. And first is higher for longer interest rates. You've been talking about it. Interest rates, particularly long-term interest rates, have moved up. That means refinancing, taking cash out of the home is more expensive for a lot of homeowners. And second, the shift in the labor market. We're all watching layoffs increase, kind of the unemployment rate kind of tick sideways, maybe a little bit higher. But careers are no longer just a linear path upward. Jungle gym careers make it hard to document income, make it hard to document employment status. And that is typically what home equity lenders are looking for.
So walk us through more of the stats on homeowners experience negative credit shocks in a given year.
Yeah, so kind of we looked at these labor market credit shocks, things like a loss of a job, a shift into unemployment, a shift into self-employment, or even just a decline in income if someone takes a job that has lower pay than they previously had. That's all, the longer it goes on, potentially going to affect their credit score. And that means they might not be able to access their home equity. In total, we estimated about 5 million Americans, 5 million Americans with a mortgage can't access their equity. That locks up about $730 billion in home equity. In a good year, about 1 in 9 Americans experiences one of these shocks. In a bad year, it can be much higher.
Does this vary by region from what you've seen?
Sure, there is kind of some regional variation. The biggest kind of clusters of locked-in equity are in the West and the South. There's also kind of 150 to 120 in the Midwest and Northeast. But again, the West, kind of where home values are very high, and the South, where there have been a lot of home purchases recently, homeowners who locked in relatively high mortgage rates.
Is there any remedy that's in sight? What's your outlook?
The labor market is shifting, and the reality is home equity lending has not kept up with a shifting labor market, a shifting economy. And so, instead of borrowing from accumulated home equity in the past, I think it increasingly makes sense to borrow against future home equity gains.
Aaron, thanks so much for taking the time here with us. Thanks for breaking this down as well. Really important issue.
Thank you.
Coming up, we're tackling all things investing to kick off our week-long financial playbook for the class of 2025. Our week-long theme week kicks off today, the class of 2025's financial playbook. Whether you're a new grad or a parent of one, we'll break down the basics you need to build a strong financial foundation. We're talking the basics of investing today, why it's worth it, how to do it, and what to be mindful of. With me now to discuss, we've got Nick Holman, who is the Betterment's Director of Financial Planning. Good to have you here, Nick. So what are the benefits to investing in the stock market instead of just keeping your cash in a savings account?
Yeah, great to be back. First off, I want to say cash is king for a lot of use cases. If you need the money within, say, 12 months or less, that really short-term time period, I would recommend not investing in the first place. So things like emergency funds, day-to-day expenses, or just any major purchases that you need within 1 year or less, keep that in cash. Now, with that set aside, investing in the stock market has huge rewards if you're willing to ride out the ups and downs. Just a few quick data points. The stock market's going to outperform cash roughly 70% of the time. Those are pretty good odds. And if you look back over the last roughly 100 years, stocks on average will perform 3 times better than cash. So when you compound that over the next 10, 20, 30 years, you're going to be looking at much more wealth gained by investing in the stock market, where it's going to be much more difficult to become financially independent sitting in cash.
And so what types of accounts do you need to invest in the market?
Yeah, there's a lot of account types out there. I will say the typical investor is going to need more than one type of account to really meet all of their financial goals, but don't overcomplicate this for yourself. I like to break things out into 2 types of buckets. First off, it's going to be your more general purpose accounts. These accounts aren't going to have as many restrictions or contribution limits or age requirements. Short-term things are going to be like checking and savings, or just general investing accounts. If you're married, maybe a joint account, but those are really easy to get started. When you're saving for more specific types of goals, That's where you can open a specific type of account that's going to give you really great tax benefits. A few examples would be if you're saving money for college, look into a 529 account. If you're saving money for health-related expenses, maybe consider an HSA. If you're saving money for retirement-related expenses, look into an IRA, a Roth IRA, a 401k, things like that. All of those are going to have really wonderful tax benefits, but they come with additional income limits, withdrawal limits, more rules. So you want to make sure that you understand those rules before investing. And here's where it's really helpful. You as the investor can choose exactly how much or how little guidance you want across all of these account types that I just mentioned. So if you want to go full DIY, you can do that. If you want a little bit of help, consider looking at a robo-advisor, maybe like Betterment, or if you want a full dedicated human financial advisor to really walk through all the ins and outs for you, that's where you can look at partnering with an advisor. But there's really lots of choice when it comes to how much guidance and assistance you want when it comes to your investing accounts.
And so let's define some terms for our newer investors who might be getting ready to buy stocks or ETFs. Market order, limit order, stop order. We've all heard these. But how at Betterment do you define these, and when should you use them?
Yeah, a market order is going to be probably the easiest to understand. That's when you say, hey, I want to buy shares of this stock or this ETF, and they're just going to be filled immediately at whatever the best available price is. The next step is going to be a limit order. And here, you're not as worried about getting into the market right away. What you're saying is, hey, I'm interested in buying these shares, but I'm only interested if I can buy them at this price or better. So you can put in the price, and then different brokerages will let you choose if it's going to be good for the rest of the day, the week, the month. You can choose different time periods. But remember that it's only going to get executed, meaning you'll actually only ever buy the stock if it hits that limit price that you entered. So that can give you a little more control. And then a stop order, these are kind of a mix of the two. They're probably the most complicated out of these three types. And so if you're new, maybe I would put this to the side, but they're going to only kick in once a certain price hits, but then at that point, they will become a market order. So a little more complicated. I'd say if you're just getting started, market orders are the way to go.
So investing isn't without its risks, and you have 3 ways that investors can manage the unknown in their finances. Your first tip here, build a foundation. Break down what you mean by that.
Yeah, all investing has risk. Let's just get that out of the way first. You can't avoid those risks, but by building a strong foundation, you're giving yourself the ability to ride out those risks if and when they do happen. So what I mean by a foundation is, watching the stock market dip 1,000 points in one day, that can be gut-wrenching like it did just the other week. But if you know that you have a 6-month emergency fund in place, if you know that you don't have credit card debt, if you know that you've built a long-term financial plan, all of those things will help you weather the storm, stay calm, and not panic when things get a little bit scary. So that's the first strategy that I'd recommend to help combat these investing risks. Second is educate yourself. If you're a recent grad and you're new to this, there's a lot of data out there. We can look at historical times, and you might think, oh, this is so scary.
Exactly. Nick, I'm so sorry. I got to jump in. We're actually going to post the tips that you've sent us, though, here. We got to leave things there. We're pushing up against the end of the hour here. Everyone.
All right, Brad.
Thanks. Thank you so much for watching Wealth.